Hey everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be doing a stock analysis on Realty Income, ticker symbol O. In today's stock analysis, I'm going to go over Realty Income's last earnings, as well as go over my DCF model and share my valuation, as well as the inputs into that model. If you like this type of content, please consider subscribing to do videos on personal finance, investing, and stock analysis. Thank you so much for watching. Back to your content. Now, Realty Income had their last earnings on the 4th of May. They missed by 9 cents on the normalized. Funds from operations and negative 6 cents on the GAAP side. The revenue came in at $807 million, and they beat by almost 60 million there. On the estimate for next quarter, they look like to have funds from operation of 43 cents a share. Revenue estimates are slightly down with revisions mostly on the positive side with 2 negative. So we'll be looking for that in early August. All right, jumping into Realty Income, ticker symbol O's DCF model. Now going straight to the valuation, I have them at $89.61 and $71.40 for the Ebitda multiple. Now let's talk about some of the inputs on how I got to that number. So starting with the growth rate, I have them at 45%, 10%, 9%, 8%, and 7% from 2022 to 2026. The discount rate, I have it 11%. This is what's used for bringing back the free cash flow, or in this case, the funds from operations back and discounting those. Now, lastly, I have long-term growth rate at 7%. This is, I think, a pretty good number. While it is high compared to some of the other companies I do valuations on, looking at their past growth record and I think what their capability of growth is, I think that is definitely sustainable for the next 10 to 15 years. On the current shares outstanding, I have them at 372, increasing to 595. So quite a high increase there. But again, I'll talk about this a little bit later, but this is how they are financing buying new properties and increasing their revenue growth. So this has been consistent on how they're doing this. So again, growth analyst expectations is 45% for 2022. That's what I have them at in my model. And for 2023, analysts have them at 13.8%. I have them growing at just 10% in 2023, but I think that is more realistic than what analysts are at right now. One thing just to remember is REITs, they have a dividend, and the dividends are taxed, in my opinion, unfavorably at ordinary income. Doesn't really matter who you are. If you can get, a better, getting long-term rates on your dividends, then that's better. But with REITs, it's always ordinary income. You can't get around that. The only way you can really get around it and deferring it is putting, buying it up in a tax-deferred account, like a 401k tax-deferred. So it just depends on what you're doing. If you're doing Roth, again, you're paying the taxes up front. It's tax-free moving forward. So it's up to you how you want to go about that. Shares outstanding will continue to expand as it's the main revenue, main way they're raising financing money in order to raise their growth through the revenue. Wow, that was a really terrible way to say that. But moving forward into EBITDA ratio. So you can see their EBITDA ratio over the last year. It's essentially, their EBITDA over their revenue. And you can see that has been rising consistently all the way up to 91.54%. So I think consistently we can say that this will stay on the higher end of this range. They've been able to execute for the last 4 years over 91%. So I've basically projected that out in the next 5 years and can keep them at 71%. On the adjusted funds from operations ratio, again, that's funds from operations over their revenue, seeing what it looks like. Again, that's increased from 60%, been increasing steadily. If you're looking over the last 5 years, it's gone from 66 all the way up to 71%. It looks like it's on the rise. So again, being conservative, I'm keeping that stable through 2026, but you could argue that this could get a little bit higher. But again, this is an excellent looking trend here. Love to see that. Now, lastly, on the revenue growth, you had 9%, 7%, 10%, 9%, 12, 10, and 26%. This 26% is due to a bigger acquisition / merger. They bought, I forget who they bought at this point. But the point is they were able to raise revenue that way, and that's also why you're seeing some big jump here in 2022. So the last thing I'll say here is moving forward, I do think these revenue growth rates are realistic based off of what they've been able to execute on in the past. If they have any big mergers, you could see this rise, but you're probably going to see a larger increase in the future the shares outstanding, which is probably going to offset it for the most part. So all that being said, I think they're currently trading around $60, $68, $70 a share, which puts them around $20 undervalued. So, I mean, I do think there is considerable upside with Realty Income. The only concern I do have with this stock is the general market conditions. How is retail going to be doing moving forward? Again, all signs have been against it, but they do have really great tenants. They have top tier properties, top tier tenants, and they're relatively diversified. They are one of the best REITs out there in the business. So honestly, I do think that they are undervalued based off of this calculation. I do hold them. However, again, just based off of my tax situation, that's not great for me with the dividend situation. But, I'll take the money, pay the taxes on it, hoping for some of this capital appreciation. If it does get closer to, $80, $85 a share, I will probably consider selling because, again, take the capital, take the long-term capital gains for me at this point, and then just go ahead and stop paying that and reinvest it into another investment. Unless once it gets to that $80, $85 range, I think this has gone up, then I may hold on to Realty Income. It just depends. This has been a good investment for me so far. I do want to just be mindful of how rates are going to shift things moving forward. Since their main financing is in their shares, I don't think increasing interest rates are going to affect them too much, but we will want to pay attention to that if it is going to have any negative impact on them. I don't expect it to have too big of an impact on them, but we will want to pay attention to that. I could be wrong. If you like this type of content, please consider subscribing, hit that like button. Thank you so much for watching. My name is Frank Finance. Out.